It's a big week for economic data in the UK and US. And after last week's gyrations, the markets will be watching the numbers even more closely. Here in the UK, we get numbers on inflation and the labour market. When it comes to inflation, we are likely to see the end of the dramatic declines in the headline rate, which has taken us from, double-digit rates just over a year ago to bang on the 2% target for the last 2 months. The best guess is that this week's numbers will show the headline rate rising to 2.3%. Further increases to around 2.7% by year end are likely, and the outlook for 2025, that's not very good either. Now, the Bank of England, that does look through temporary movements in inflation. They focus on getting it sustainably towards the 2% target over time. Having made its first cut at the last meeting, but by the narrowest of margins, recent developments will have made the committee even more cautious. Now, there are two quite separate reasons for the recent gloom over the prospects for UK inflation: energy prices and wages. Now, much of the recent decline in UK inflation, that reflects movements in the Ofgem price cap for household energy bills. These more than doubled following Russia's invasion of Ukraine and have since fallen by 40%. The first rise since that decline set in will come in October, when the price cap goes up by 10%, and we'll probably get another increase in January 2025. Wage inflation, that could prove to be an even bigger problem for the Bank of England. Although wage inflation has fallen from the highs, it remains well over 5%, and that's far too high to be consistent with the 2% inflation target. Now, the figures out this week may show a little bit of an improvement, but the underlying trend seems to be for wage inflation to have edged a little bit higher so far this year, and that's occurred despite the hefty declines in headline price inflation. The stronger economy is one reason, but decisions by the new Labour government, they have made the outlook much worse. Now, the decision to award the junior doctors 22% over 2 years, coupled with meeting the 5.5% recommendation for public sector pay in full, they were both well above expectations. Now, the public sector is a huge employer, of course, and these numbers will boost private sector wage inflation. And there's another more direct effect coming from the government, which is their decision to further raise minimum wages relative to median wages next April. Now, in the absence of this further relative move, the minimum wage may have risen by only 3.9% in April. The outcome is now likely to be 6% or even more. So, a scenario whereby lower headline inflation leads to lower wage growth, allowing the Bank of England to cut interest rates despite improving economic growth, that's been replaced by a much less optimistic scenario. Now, the market is currently pricing in another 50 basis point of cuts by year end, with another 50 basis points of cuts by June 2025. I think there's a risk we get fewer cuts. Indeed, having been very optimistic about the prospects for UK growth, UK inflation, and our interest rate cuts, I'm now moving firmly in the other direction. All is not lost, though. If, it seems likely, the US starts cutting rates, this could strengthen sterling, and that would improve our interest rate prospects. We should see better UK growth and a drop in wage inflation over the balance of this year. But the net balance of risks for the UK, in my view, has changed, and not for the better. So until next week, goodbye from me.